Hey everyone, welcome to The Explainer. If you've been keeping an eye on the markets lately, you know things have gotten, well, incredibly bumpy, especially when we're talking about artificial intelligence investments. We've seen massive sell-offs, circuit breakers tripping overseas, and just some serious, genuine anxiety creeping into the tech sector. It's like suddenly, the whole narrative around AI has completely shifted. We went from unbridled enthusiasm to a very real panic about immense costs and absolutely brutal competition. But what is actually going on under the hood here? Today, let's look at the numbers together, hear out the smartest skeptics in the room, and analyze what all of this really means for long-term equity investing. It's going to be a fascinating ride, so let's get into it. Here's a quick look at our roadmap for today. We are going to hit the market reality check, dive into the commoditization debate, explore the service wrapper mode, tackle capex and business quality, and finally, break down the valuation equation. All right, Section 1, the market reality check. To really understand the panic we're seeing right now, we have to zoom out and look at the macroeconomic headwinds that basically slam the brakes on the tech sector's incredible momentum. It was kind of a perfect storm all hitting at once. The trouble really started with the Labor Department's blockbuster May jobs report. The U.S. economy added a massive 172,000 jobs, which was way more than economists were forecasting. Now, you know, a booming job market is great for Main Street, but investors, they had been banking on the job market cooling down so the Federal Reserve would cut interest rates. Instead, the market suddenly had to price in a higher rate environment for longer, and historically, that puts a huge damper on high-growth AI stocks. Immediately following that reality check, we got Broadcom's earnings. For months, these AI darlings have been delivering the classic beat and raise. You know, beating expectations and then raising future guidance. Well, Broadcom just beat. They didn't raise. That slight deceleration, it sent the stock tumbling 17% in a single week. And finally, you have some harsh corporate reality setting in. Uber CEO actually admitted they blew through their entire annual AI budget in just one quarter. A single quarter. They were forced to suddenly limit developer spending. So basically overnight, AI prudence was born.
So this crucial point is encapsulated perfectly by this phrase: asset-light tech is suddenly asset-heavy. Look, for the last decade, tech investors have been totally spoiled. We own software businesses that required very little physical infrastructure to generate massive cash flows. But overnight, utilizing AI has proven to be incredibly expensive. These tech darlings, Google, Meta, Microsoft, they're suddenly spending hundreds of billions of dollars on heavy infrastructure and capital expenditures. This isn't a blip. This is a fundamental transformation of the entire tech sector, and it's making investors incredibly anxious because they're asking a totally fair question. Are these businesses actually turning into worse businesses?
That brings us to Section 2, the commoditization debate.
This debate right here is the absolute heart of the bearish argument right now. Prominent AI skeptic Gary Marcus argues it like this: everybody is building essentially the same technical solution. There is no moat. You get the price wars of commodity pricing. And legendary investor Steve Eisman has echoed this exact same sentiment. He pointed out that there just really isn't much difference between products like ChatGPT and its competitors, that people switch constantly, and therefore absolutely no one is going to be able to charge monopoly prices. Their core argument is that these hyperscalers are spending hundreds of billions of dollars to build a product that will ultimately yield, just modest commodity-level profits in an intensely competitive arena. And we really have to give serious, balanced weight to this critique because it strikes right at the core of the entire AI investment thesis.
And honestly, when we look at the underlying facts, the bears actually have a really good point. AI models absolutely are acting like commodities right now. I mean, there are over 100 different AI models available today with varying performance benchmarks. And there's this constant leapfrogging happening. One month OpenAI has the absolute best model, then the next month it's Grok, then the next month it's Google's Gemini. It's just this endless cycle. Contrast this with a company like ASML over in chip manufacturing. There is no list of the top 10 EUV machine makers. It's basically just ASML. They have a clear, undeniable monopoly. In AI models, there is no singular winner. The raw product is absolutely, unequivocally being commoditized. But all of this brings us to a massive multi-billion-dollar question. Does a commodity equal zero pricing power? Does the fact that the underlying AI model is a commodity automatically mean these tech giants are doomed to terrible returns? To answer this, we need to step back from the current panic for a second and look at the historical reality of long-term equity investing. Which leads perfectly into Section 3, the service wrapper moat.
History proves over and over again that wrapping a raw commodity in a stellar ecosystem creates a massive moat. Let's look at Amazon Web Services, specifically their S3 storage product. Long before the current AI boom, AWS was growing 30% year over year, hitting over $60 billion in revenue by 2022 and commanding operating margins of around 30%. How? Well, the product on the left, basic web storage, is the ultimate commodity. But Amazon didn't just sell raw storage. They sold the service wrapper on the right. They sold global availability, versioning, advanced security, analytics, compliance, and perhaps most importantly, developer trust. They packaged the commodity to make it distributable, secure, and incredibly easy to use. The storage was the commodity, sure, but the wrapper surrounding it was highly differentiated, and that gave AWS massive pricing power.
Let's see how this exact same concept builds out in a totally different industry, like consumer entertainment. Think about Spotify and Netflix. Spotify generated over $3 billion in net income in the trailing 12 months. But look at the left side. Spotify doesn't even own the product they sell. They just resell licensed music from record labels. It is the exact identical content you can get on Apple Music or YouTube. It's a pure commodity. Netflix does the exact same thing with third-party licensed shows. So where on earth is their moat? It's the service wrapper on the right. They sell superior discovery algorithms, perfectly seamless user interfaces, user profiles, and social networking built right into the app. People pay because the ecosystem works beautifully. This proves, without a doubt, that a superior user experience built around a commoditized product equals incredible pricing power. Now, I want to share a number with you that completely shatters the idea that you can't make incredible money selling a raw commodity. 17.7%. This is a return on capital employed that rivals some of the very best tech businesses in the world. But who is earning this? Any guesses?
It's Texas Roadhouse. Yep, the restaurant chain. Standard commodity returns usually hover right around 8 to 12%, but Texas Roadhouse consistently earns a 17.7 to 20% return on invested capital. How are they pulling that off? They sell steaks. A steak is literally a commodity. There are absolutely zero barriers to entry to selling a piece of meat. But Texas Roadhouse isn't just selling the steak, right? They are selling the operations, the consistency, the efficiency, and that warm guest experience. They figured out exactly how to wrap a literal piece of meat in an ecosystem of flawless execution. So when skeptics say AI has no moat because the model is just a commodity, remember this dynamic. If you build the right foundation around a commodity, your returns can be absolutely spectacular.
Let's move on to Section 4, CapEx and business quality.
So, even if these tech companies successfully build a service wrapper around AI, we still have to address the giant elephant in the room, the fear that spending hundreds of billions on heavy capital expenditure automatically ruins long-term business quality. Basic financial theory says moving from asset light to asset heavy makes a company fundamentally less attractive. But let's look at the financial realities of Costco. They grow by building massive, super expensive physical warehouses. Look at these margins. Profit margin below 3%, operating margin below 4%, gross margin just 12%. By the raw numbers, this is an ultra-low margin, highly capital-intensive business. Yet, look at the bottom row. Costco commands a massive premium multiple, a 45x forward PE ratio. The stock market is literally willing to pay 40-plus years for their earnings. Why? Because despite being incredibly CapEx heavy, the business is exceptionally consistent, it's reliable, and it generates massive excess returns. The takeaway here is absolutely vital for AI investors. Being CapEx heavy does not automatically ruin business quality, provided the company executes with absolute consistency. And finally, Section 5, the valuation equation.
Because building all this heavy AI infrastructure requires a ton of cash, we are seeing the immediate reality of how companies are forced to pay for it: equity raises and dilution. Let's break down the math behind recent market rumors regarding Google and Meta raising capital. Let's say, just as an example, both companies want to raise $80 billion for AI infrastructure. Google currently trades at a forward PE of roughly 30x, while Meta trades at roughly 19x. Because Google's valuation is so much higher, achieving that $80 billion goal only requires diluting their current shareholders by about 1.8%. A long-term investor might actually cheer that move as a really smart, cheap way to fund the future. But for Meta, sitting at a much lower multiple, raising that exact same amount of cash requires 5 to 6% dilution. That is a vastly more expensive cost of capital, and it hurts the existing shareholders so much more. This is why valuation is incredibly protective during an asset-heavy transition.
And that brings us to the ultimate question for you to take away from this explainer today. Who is going to build the ultimate ecosystem around the AI commodity? We've seen that the raw AI models are indeed becoming commoditized. We've seen that the infrastructure costs are frankly staggering. But we've also seen that history deeply rewards companies that can take a raw commodity, whether that's basic web storage, licensed music, or, hey, even a steak, and wrap it in a flawless, highly integrated service.
So as an investor, or just an interested observer of this whole tech revolution, I challenge you, stop worrying quite so much about which specific AI model wins today's arbitrary benchmark test. Instead, start looking for the companies that are building the strongest, most lucrative distribution wrappers for tomorrow. Thank you so much for joining me on this explainer, and keep your eyes on the ecosystem.